Hi everyone, I'm Jason Blum.
And I'm Jason Basler.
We're here with HSB Advisors in partnership with the Friends Foundation. And what we're doing here, we're going to discuss today is kind of the changing landscape, more or less a year in review for some things for you folks to take into year end, whether it be tax planning, charitable giving, or whatever the case may be. We're hoping you can take these nuggets and kind of clear the air on what you're seeing in the news. Again, we always encourage you to consult with your trusted professional, whether it be financial, legal, investment advice. We're not here to offer any individual investment advice as a disclosure, or financial or tax advice. So we're here, we're gonna jump into things, and more or less what we're gonna do is we're gonna build on the plan we discussed back at our April meeting. And again, we wish we could see everybody here in person, but out of sake for safety with everything that's going on, we're hoping you can enjoy this video at your leisure. So without further ado, we're going to go ahead and jump into this. It's a little bit of an overview. What we're going to do, we're going to build on the discussion from the April seminar, and our focal point at that seminar was more or less, hey, have a plan, all right? Whatever your wishes are, whether they be tax, charitable, establishing a legacy, whatever the case may be, just have a plan with that course of action. So we're also going to discuss the changing tax landscape, and kind of where that came from is, as we ended our last discussion, one of the pieces that was still kind of up in the air was what's going to happen with this tax proposal. And again, I know everybody's seeing things on the news, and we just want to kind of clear the air on what we're hearing, because depending on what channel, what station you're on, you hear one thing, you flip the channel, you hear a completely separate thing. So we're going to hopefully give you some nuggets to kind of clear the air on things there. And then, obviously, you know, in partnership with the Friends Foundation, we always want to discuss charitable strategies to hopefully help you give most tax efficiently. We know that's not the driving force behind charitable giving, but obviously if we can help you in a tax efficient manner, well, that's just the cherry on top of things. So again, we're going to go ahead and jump into the Secure Act 2.0. I'm sure a lot of folks are seeing this in the news right now, and Jason and I are going to elaborate on this in a little bit further detail. But there's a lot of implications from the Secure Act 2.0, and this kind of builds on the 2019 Secure Act that went into play for 2020. And a lot of things, how this is going to affect some of the folks that are watching this video right now is the RMD. So that required minimum distribution that you got to take out of an IRA. It's going to get pushed back to age 75. This is after 2031, and it's a staggered cliff. So there's incremental increases in the interim, 73 through 2028 and 74 up to 2031. Just meaning that you're not going to have to take that minimum amount until a later date. So right now that's 72. It used to be 70 and a half, and they're going to go ahead and push that up so you have more time to let those dollars kind of brew.
Yeah, so one of the big things that's in the new legislation is on the RMDs, the required minimum distribution, which is the amount you're required to take out of your IRAs or 401ks in any year, is if you're under $100,000, you're not going to have to take any dollars out of that at all. That's a huge perk for making your money last as long as you do. So the other thing is this is really big. So it will allow for a Roth IRA provision if you have a simple or a SEP plan. There again, one reason that small companies need to move over to 401k type plans, which are a little more expensive, is because they have the Roth IRA options. So if we can get those options under a simple or a SEP, that's going to just help small businesses out tremendously. The other thing that's in there is catch-up contributions. We've all heard of this. Typically, it's as you get to age 50 and older, you could add another 1,000 to IRAs and another 5,000 to your 401ks. Under this plan, they're actually talking about adding $5,000 after the age 62 to 64, $5,000 if you have simple IRAs, and $10,000 for other type of qualified plans. So I guess the moral of the story is, if you're planning to retire before 62, you have to have earned income in order to do these, so you might be retiring a little later. The other thing that's in there is something called a saver's tax credit. Right now there is a saver's tax credit under the current law. that is a $500 credit if you're in a lower income bracket. They're looking to expand that. There's all types of proposals out there on how to expand it. I'd say more to come on that, but there will be some expansion of that credit to allow people to save more money.
So then we get into the spending or revenue problem, and again, this is in relation to the federal government. You know, our last discussion kind of focused on, hey, taxes either got to increase or the government's expenses got to go down, and we kind of know how that trend line works. Expenses continue to go up, and revenues right now are relatively flat. So how do we go about this? Well, we got to bolster the federal government's revenue, which is tax based. Right now, again, a lot of what you see on the news is this infrastructure plan, and we want to kind of clear the air on that. What's going on there? So since March 2020, kind of, we'll call it the coronavirus spending, we've totaled about $5.6 trillion. Well, what we've got in the House right now, or going through legislation right now, up for proposal, is a $4.1 trillion infrastructure plan. Now, traditionally, whenever we think of infrastructure, we think of roads, bridges, the tangible items, but a big piece of this is actually the intangible items. So actually $550 billion is your traditional infrastructure, your roads, broadband access, so getting internet to folks. $550 billion of that is the traditional infrastructure piece. The human infrastructure piece, which includes education, these expanded child tax credits, anything that is more or less intangible to provide that social safety net, Medicare, Medicaid, that is actually $3.5 trillion of this particular infrastructure plan. Now, what we're hearing is it might not be 4.1 trillion, it might be more in the $2 trillion range, excuse me. But there's going to be something passed, and what does that do? Again, that goes back to our spending problem. Well, how does that affect us as individual taxpayers, potential donors? Well, they've got to raise the funds somewhere. So again, that brings us to the tax proposal plan.
So I think under the tax proposal part of the Biden infrastructure plan, they're looking to increase the highest marginal tax rate to 39.6%, which is up a few percent from where it is currently. The big kicker here, and this doesn't affect everyone, but if you're making over $400,000 as a married couple, this is where a lot of changes are going to happen for you. A couple of the changes are, number one, there's something out there called a Roth conversion, to where you can actually take some of your pre-tax dollars and roll those to a Roth IRA, pay the taxes now, let it grow tax deferred, and actually take it out tax free whenever you are greater than 59.5. If you make over $400,000 in the year 2022, it looks like that is going to go away for you. So year-end planning, may want to seek some financial and tax advisors to find out if that makes sense for you to go ahead and do some conversions now if your income is over $400,000. The other big key is on the child tax credit. There's been lots of talk about child tax credits. So everyone that has a child under the age of 17 right now is getting a check in the mail every month, unless you've opted out. But one of the things that we're hearing so much about this child tax credit, one of the things is so the credit went from $2,000 per child to $3,000 per child, and actually if that child is under 5, you're getting $3,600. Half of that is refundable right now, so that is the check you're getting. So whenever it comes time to do your tax return, you're actually only going to feel half of that credit on the return. So last year, 2020, you got a $2,000 credit for each child under the age of 17. Now that is a $3,000 credit, but there again, you're getting half of it now. So when you do your tax return, you're only going to feel the effects of $1,500. That is a $500 difference on your tax return. So if you have one child, your refund is going to be $500 less. If you have 2 children, that is $1,000, and so on and so forth. So whenever it comes time to do tax returns this year, be ready for a change and prepare for it now. If you're over $400,000, that $3,000 credit that we just got the bump actually came back down to the $2,000 that you were getting all along.
So again, hopefully this affects somebody here that's watching this video, but just an idea of how these changes are going to work. We talked about that RMD, that required minimum distribution that you got to pull out of IRAs, qualified accounts. Actually, if you have more than $10 million, there are significant changes. Again, doesn't affect a whole lot of people, but just so you know, the moral of the story is the government's trying to raise dollars, and they want those dollars sooner. So even though it's $10 million today, what does that number creep down to in the future? Because of this, revenue still lags spending by a significant percentage. So again, these items that are kind of going through today might not affect you or me or your neighbor, but down the road, again, these are going to kind of continue to trickle down, and at some point, we're going to be affected by some of these changes. So just to give you an idea, again, taxes are probably going to be on the rise, and right now all this stuff is in proposal. Again, the infrastructure plan might come through at $2 trillion, and what does that do? Well, that makes our budget a little bit more balanced. But just so everyone knows, get ready to potentially up the tax ante in regards to future payments.
Before we move forward here, I got two more thoughts on that over 400,000. Number one, capital gains are going to be going up for folks over 400,000. Whenever this proposal came out, they started at $1 million. If you made more than $1 million, capital gains were going up. They've kind of brought that down to 400,000. But if currently capital gain rates are 15%, 20% if your income's high enough, but those are going up to 25. And if you live in Missouri, you've got another 6, and under the ACA, it's another 3.8. So your capital gains are going to be pushing 30. I think that's 34.6%, starting probably after 2022. So there again, these are folks over 400,000. But if you have highly appreciated stocks or some kind of capital gain you want to get rid of, it's probably time to do it in 2021 rather than 2022. There again, should seek out individual tax advice for everybody's individual circumstance. The other thing is that inside of the infrastructure bill is increased spending to the IRS. So they have said they're hiring more agents. They're going to increase their infrastructure or make it more effective. And they are going to audit folks more than 400,000 by tenfold, starting, I believe, in 2023. So there again, those folks over 400 grand, you know, you just might want to consider that going forward, as you have a 10 times more likely chance of being audited going into the future.
Yeah, so that kind of leads to tax efficient planning now, and this is more so in regards to the charitable strategies. So again, if we know tax rates are going to rise, again, let's do this as tax efficiently as possible, so you're putting more dollars in your pocket as well as the donor's pocket, the donee's pocket, excuse me, whether that be the Friends Foundation or whatever charitable organization you support. So again, we're going to elaborate on this. We discussed this at our April meeting, but we're going to elaborate on it again because this is an important piece going into year end. So again, just so you know, in 2021, you actually get a $600 above the line tax deduction, charitable deduction. So again, if you give $600 in cash, you're going to get the $600 deducted on your tax return. So otherwise, typically you got to have more than $25,000 in deductions. So what we've discussed in the past is consider lumping those charitable donations if you're going to be able to hit that $25,000. For example, let's say you give $10,000 a year. Well, what could make sense is rather than give $10,000 every year individually, maybe you say for 3, 4, 5 years, I'm going to give $50,000 this year, but over the next 4 or 5 years, I'm not going to give anything. So again, getting a deduction on this year's tax return, subject to certain limitations pertaining to AGI, but just so you know, you might want to consider lumping those charitable contributions. Again, Jason alluded to it earlier, the highly appreciated stock. If you have stock that you've been wanting to get rid of, but you can't because of significant gains, maybe you donate that directly to the charity of your choice. The perk there is you don't pay any tax on it, and neither does the charity, and you're able to get your portfolio back in alignment with how you intend it.
I think the last one is the donor advised funds. There again, kind of as Bloom alluded to, as far as grouping those donations, this is a way to do it without actually giving the charity all the money at one time. So there's actually funds set up out in the universe that you are able to throw $25, $30, $50, $100,000 or whatever your desired amount is into this fund. It counts as a donation the day that you put it into the fund, but then from there forward, you kind of control every year on the distribution to up to as many charities as you really wish, but you just make a phone call into the company that's the custodian, and they will issue the checks to the charity of your choice. There again, you get that upfront tax deduction immediately as you give it.
And then last but not least, qualified charitable distributions, so QCDs we call those. That's if you're over 70.5 years old. This is a very tax efficient way to give. If you have IRA dollars, you can actually give that IRA, make a check payable directly to charity. You don't pay tax on the dollars. You may be able to meet your R&D requirement, that minimum amount you got to pull out, and the charity doesn't pay tax. So again, it's the best of all worlds. It's almost like your own little charitable account, kind of like the donor advised fund, but this one you own individually, and you're able to get tax deferred dollars out essentially tax free, and essentially helping your legacy and helping your local charities or whatever charity you might choose.
There again, I think Bloom mentioned this, but that is you can do up to $100,000 every year. And the one question I get a lot from the tax side is, hey, I gave money to a charity as a qualified charitable distribution. I still got a 1099 in the mail. I thought you said we weren't going to pay tax on it. So you will still get that 1099 in the mail. What you're going to have to do is talk with your tax advisor and show them some proof that you gave that directly to a charity. And then there's some mechanisms within the tax return that allow that to be a tax-free distribution.
Yeah. And just as Jason alluded to, again, this isn't meant to be, individual tax, financial, or legal advice. So we encourage you to consult your trusted professional in those respective fields. Hopefully this spurs a conversation to help you accomplish what you're trying to accomplish. And again, if the Friends Foundation can be a benefactor, we love that too, because they're doing great things. So again, thank you for your time. We appreciate it. We wish you a safe and well year end. Happy holidays as they come up. It's crazy that's right around the corner. But we hope to be meeting with you folks in person in the spring here next year. So again, if you have any questions, we encourage you to reach out to one of us, your trusted professional, somebody at the Friends Foundation. We're always here to help. And again, we thank you for your time. Take care.
Thank you.